Hi, Everything Money is a popular finance channel here on YouTube, and they have something called the 8-pillar process, which are basically 8 screener conditions. The idea is that if a stock matches to all 8 screener conditions, then it is a good company that is potentially undervalued, and the implication is that if you invest in stocks that match to all 8 screener conditions, then it will potentially outperform the stock market in the long term. In this video we will going to backtest this and see whether it can outperform the stock market, and in the end of the video we will also try to find improvements into this 8-pillar process. So let's get started here on long-term stock fundamentals. I already typed in all the 8 pillars, all the 8 filtering conditions we want to backtest. It can be grouped into multiple parts. The first part is related to how expensively the stock is priced, which is a 5-year price to price earning and the 5-year price to free cash flow ratio, both of which we want less than 22.5. The next 3 is related to the growth of the company. We want the company to grow both free cash flow, net income and revenue. Next up we have one related to the dilution, or more precisely the lack of dilution. We want the company to not increase its share count, and actually we really want it to decrease its share count. Next up, 5-year return on invested capital, which we want larger than 9%. And finally, we have the long-term liabilities divided by the 5-year average free cash flow, and we want it to be less than 5. What this means is that using the average cash flow, it will take less than 5 years to pay off all of its liabilities. I will going to backtest it on the Nasdaq and the New York Stock Exchange, so all the US exchanges from 2004 to 2022. What backtesting means is that it will go through all of these years, and every single year it will invest in all the stocks that match these filtering conditions in equal amount, and then calculate the annualized return since the invested time till today, including the dividends. Clicking on backtest, it will do this backtest for us, and as you can see, this chart and table summarizes the result. The chart shows what is the annualized return versus the S&P 500. So for example, here in 2014, the annualized return, if you invested in all of these stocks returned by this 8-pillar process, is about 6.4%. If you reinvest also the dividends which you get from these stocks, then you get about 8% return, versus the S&P 500 here in red, which is giving about 9.2% based on just the stock price increase, and about 11% with reinvested dividends. As you can see, there are some big losses here, though these are relatively short term, and there are some victories as well. Overall, the median annual return is almost exactly the same between the screener and the S&P 500, and also the average return is very close as well as all the returned money is very close together. So the conclusion here is that using this screener condition roughly returns the same amount as the S&P 500. Now, to be fair with the Everything Money, they recommend using a DCF calculation to calculate the fair value of the company, besides just checking the 8-pillar process. And they also mention that just because a company matches the 8 pillars doesn't necessarily mean it's a buy, and if it doesn't match, doesn't necessarily mean that it is not a buy. However, if you provide a screener, I do expect a little bit better result than the S&P 500. So let's see if we may be able to fix something in this screener to have better returns. First thing that comes to my mind is this 5-year PE and the 5-year price to free cash flow ratio. So I see 2 issues with it. First of all is that it is for 5 years, which means if there is a sudden drop in the stock price, let's say as a random example, there is a pandemic, then it does take a while for this 5-year PE, for example, to decrease, even though so the last quarter the PE or the last 1 year PE is already low. The 5-year PE might be high because in the past the PE has been high. My second issue here is with this 22.5. So a company that grows, let's say 5% per year, the 22.5 is PE is very high. However, a company that grows 50% per year, the 22.5 PE might actually be low. So we have to find some way to automatically assign these PE values based on the growth, because the PE and the price to free cash flow cannot be viewed in a vacuum. So to fix it, I'm actually going to delete both of these. And I'm going to add the trailing peg ratio here. The trailing peg ratio is the PE divided by the trailing growth rate in percent. So for example, if the PE is 40 and the growth rate is 40%, then if you divide 40 PE with the 40% growth, then you get 1 peg ratio. And I actually want this to be less than 1.8. And this solves both of our problem, because the PE is not 5-year, but just 1 year PE. So if the stock price is suddenly falling, then the trading peg will also immediately fall, given that the fundamentals of the stock didn't deteriorate. And the growth is related to the PE, because we divide the PE with the growth rate. So if we have a 50 PE, it will still pass if the growth is also, let's say, 50. So let's test this out. So currently we have a 10.3% and a 10.9% return with the previous condition. And if we backtest it now, we are up 12.66 and 13.5%. And as you can see, there were some losses here. Now we are beating the S&P 500 every single time using this trailing peg ratio. Next up, I want to increase this return on invested capital a little bit. So 9% is a very good return on invested capital. However, 15% is even better. And with 15% return on invested capital, the company can actually compound much faster. So let's do a backtest using the 15% return on invested capital. So we had a 12.6% average annualized return. And if we use this 15%, we now get a 14% annualized return and 15% median return. Next up, I want to actually increase these growth numbers. So it's nice that the company is growing, but it is better if it is growing a little bit faster. So I'm going to use here 8% annualized growth for all three of them. So both for the revenue, both for the net income, and both for the free cash flow. And let's do a quick check now. As you can see, now we are up to 15.6% average return and 16.1% median annualized return. So this is already very good. We are nearly beating the S&P 500 with 50%. However, we could probably go a little bit higher if we actually look for stocks that not only not growing their share count, but actually decreasing their share count 1% annually. So if we check it now, we are up to 16.5% average return and 17.4% median. Next up, I see one more possibility to optimize this is this long-term liabilities divided by the 5-year average free cash flow. So currently it is 5, but we could even find better businesses if we try to find just 2.5 year here instead of the 5 year. So if we do a backtest now, it does actually increase our return. So the average return now became 17% and 18% median return. However, I would be a little bit careful with these options because it really decreases the number of stocks we invested in, so a total of 116 stocks invested in this 18-year period. As you can see, in some years only one single stock matched all of our filtering conditions. While other year it is a little bit better, but still it is a relatively small amount of stocks, and it is making a very concentrated stock portfolio. So if one stock doesn't work out, let's say here in 2004, this didn't actually work out all that well, returning just 6% return, making it our only losing period. And similarly, it could be that the current screener is returning stocks and some of these will not do so well, so it becomes a little bit too concentrated. So as you can see, with minor tweaking of numbers and changing the filtering condition to the trailing peg, we actually increased our returns quite a bit. So the 8-pillar process only returned about the same as the S&P 500. However, with these new screener conditions, we actually beat the S&P 500 by about 70% over the last 18 years. And as you can see, our return from investing $116,000 during this 18-year period have been about 363,000 with the S&P 500 and 820,000 with our screener conditions, so more than doubled the return of the S&P 500. Now, of course, just because a stock is matching these filtering conditions, which returned quite well in the past, doesn't actually mean you should invest into all of these stocks. You should do further research. You should probably use the DCF calculation, so the discounted cash flow model. Actually, we have a filtering condition for that one as well. So the data that is by default filled in this calculator page, as you can see, it automatically fills in some data. So in case of Apple, it already has some margin of safety here, is already available as a filtering condition. So for example, we can say that the margin of safety of this calculator is larger than 0. And it can also increase our return a little bit more. One thing to note here is that stocks like Apple and Visa are usually filtered out based on the original 8-pillar process because they always seem expensive. However, good stocks are often always expensive. But this is what Warren Buffett said, that it's better to buy a great company with a fair price rather than a fair company with a great price. So that was all for today. Thank you for watching.